It's the time of the season when the blood runs high. In this time, give it to me easy. And let me try with pleasured hands to take you in this time to promised lands. To show you everyone.
Good evening, everyone, and welcome to this week's edition of Bond Squad After Hours. As always, I'm your host, Tom Byrne, Director of Fixed Income at Wealth Strategies and Management in Bond Squad. This week, I'd like to discuss the Fed, jobs, and why the narrowness of the recovery in risk assets might not be such a bad thing, even though it drives the technical guys completely batty. But first, let's read our obligatory disclaimers. Investment advice is offered through Private Advisor Group, a registered investment advisor. WS&M, LLC, and PAG are separate entities, as is Bond Squad from PAG. But, to interrupt the disclaimer, PAG has been very supportive, and we couldn't do this without them. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. And I might add, there is no one good investment for everyone, nor is there a good product or a good strategy for everyone. Everyone needs personal attention. That's what we're about here at Bond Squad, personal attention. So we look at today's market and we see that the 10-year yield is relatively unchanged. 2.223, closed yesterday at around 2.21 and change, right? So not a lot of movement on that. But what happened with the 2-year? Yes, the 2-year, the most of all the coupon treasuries, the one that's probably, well, not probably, it is the most susceptible to Fed rate increases. Remember, the Fed controls through its normal monetary policy, it controls the short end of the curve. And what we saw is that this morning, the 2-year treasury opened up around 76 basis points. It finished the day right around 81 basis points. That's a 5 basis point move. That might not seem a lot, but it's a big move on the short end of the curve, especially when we consider how low rates are. Why did this happen? Well, Janet Yellen, Fed chair, was testifying before the House today, and not on monetary policy per se, but bank regulations. She's subbing for a now vacant position within the Fed in the oversight capacity. But during her testimony, she was asked about monetary policy, and she made it clear that the December meeting is still a live meeting, as she called it. And it appears, if you listen to her comments, and I'll take her at her word because I can't do anything else at this point, that as long as the data remains solid, in other words, the economic data does not necessarily have to improve from current levels by the December meeting to keep the Fed from lifting off. This kind of took the markets by surprise because the markets have convinced themselves, this is that self-fulfilling prophecy or or denial that if the Fed is going to tighten, it means that economic conditions are improving. It might not be so much that they're improving, but that, hold on a second, we have a problem. Now we are back. Sorry about that. I had a little computer glitch. So it's not that the economic data needs to improve; it just has to remain solid. And this throws a monkey wrench into the pundits out there and strategists and economists who believe that if the Fed is tightening, it means the economy is improving. And by the way, I'm broadcasting today from the Bond Squad Lodge. Worked remotely today. Had some stuff to do that required me to be close to home. But it was thought that that's what a Fed tightening augured for, was an improving economy. Fed's saying, no, not so fast, Sparky. All it means is that things aren't deteriorating. And remember, we're talking about going from 0 to a quarter to probably a quarter to a half. And as Ms. Yellen says, and again, I agree with her with this sentiment, it's not the timing of the liftoff, but the pace of normalization. And the pace is expected to be slow, even slower than the Fed's revised dots, which indicate a slower tightening. Fed funds futures, they're not pricing in a 1% Fed funds rate to the middle of 17. Okay, so it's not that the Fed is going to raise rates. All right, it's coming off a zero bound. And this doesn't mean that the traded Fed funds rate has to be above a quarter. Doesn't mean it has to get to a quarter, but that the Fed's target range is that. We'll see what happens. But if anyone thinks that this is a sign that interest rates are going to take off on any spot of the curve, they're probably sadly mistaken. However, it does appear that the Fed wants to tighten. And we heard it from New York Fed President Dudley today. He said that the inflation expectation decline is a little concerning. He still sees examples of shortage of skilled labor, which probably don't get rectified anytime soon, by the way. And by the way, there's a shortage of skilled labor, but the majority of jobs out there are not for necessarily skilled labor. To digress a bit, it appears that businesses want very highly educated workers, very little practical experience, it appears, but a prestigious degree from a prestigious school, and then they'll give you a decent paying $50,000 a year job. Otherwise, you're working in retail. So I mean, it's kind of it's not the same. It's not the same economy. And there's a good article on Barron's about the higher mortality rate among men in their prime earning years. I tweeted it out and I put it up on LinkedIn. They're getting discouraged. They can't find work, even if they have a lot of experience, even if they have experience in the fields they want it, but if they don't have that right degree or a degree, even if they're totally competent to do the job, they cannot get hired. So there is labor slack out there, kind of, but it's labor slack that's probably unlikely to be solved anytime soon. So we might be at a technical full employment level. And by that, I mean, it's not going to get tighter than what it is. Yeah, you might get more people working in lower paying jobs as they run out of benefits, but I don't know if we see the unemployment rate go well into the forest. I think that's what's needed to put upward pressure on or more upward pressure on wages. I don't know if we get there. And the Fed's saying, you know what? There's not enough slack. There's not enough slowness in the economy to prevent us from getting off the zero bound. However, if you listen to the Fed comments, there's probably enough slack and there's probably not enough inflation to get the Fed to move far away from the near zero bound with any type of speed. And this puts us in a situation. Where's inflation coming from? Well, we just saw the dollar rally today. I mean, it took off. And this is not going to be good for your commodities producers. It's not going to be good for your tips. It's not going to be good for your multinationals. At least multinationals can be flexible, right? They can move jobs and production overseas to minimize the currency damage if need be. But the dollar index, and where did we close at finally? It was 97.9, just below 98. It did hit 98.054. To put this into perspective, the last time we were here around this level was last April, and the last time we topped it when it went to 100.33 was March 13th of this year, at the height, if you will, of the strong dollar and the and about the time the ECB launched QE officially. And we've been creeping higher. This is disinflationary. There's no way to slice it. It's disinflationary. And it's disinflationary at the core as well, because it lowers the cost of goods and services. Okay, so the Fed's inflation mandate might not be met as far as that 2% core PCE. However, it might not be that disinflationary over here. Why? The U.S. economy appears to be on a solid 2%, maybe to 2.5% trajectory. It's going to keep chugging along. As Ms. Yellen said in her comments today before the House, the U.S. economy appears solid, but we're being held back by slowness from overseas. This is the truth. We can deny it all we want. We can look at backward-looking models all we'd like. We can keep doing as much as we want, but it's probably not going to change anytime soon. This is mostly structural at this point. But now we're starting to see some cyclical factors come into play. They always say bull markets don't die of old age, but economic cycles can. If there's not much to pick up the baton from monetary policy, the effectiveness of monetary policy fades over time with age. Right? That's fading. There's nothing out there to really pick up the baton from the Fed and carry it forward. There's the idea that maybe the consumer will come in and borrow more. Maybe we get a steeper yield curve. The banks will lend more because it's more profitable to do so. Problem is, can consumers afford a higher mortgage rate? Probably not. Can the larger banks broaden the scope of potential lending customers? Probably not. In fact, the Fed is talking about increased regulation and increased reserve capital requirements. So it probably doesn't come out that we see this next leg. We're probably stuck here until this cycle peters out and we see a slowdown. We might not go to a classic recession in this whole cycle, by the way. We're only growing in the low twos, probably 2% for this year, unless we have a nice surprise in Q3. So a downturn, a recession might not be more than one, maybe not even 1 quarter of negative GDP. Maybe we go flat again for 2 quarters or thereabouts. It doesn't have to be this classic recession to be a slowdown. So that's what I think. I think it's more moderate. Remember the Great Moderation, which was kind of blown up after the financial crisis? Well, I think we're back to that. We have our peaks are lower, but our valleys will be shallower. So we're probably in that type of situation here. As for the jobs data, look, job growth is slowing. There's not that need to expand the workforce, and there's not much need to pay up. Look at today's ADP data. Now, it was encouraging that most of the gain was among small businesses, but it was still among lower paying jobs. A lot of part-time seems to be baked into that. When we look at the service sector job growth, what was a little disturbing was that business and professional services, one of the few areas of the service economy that actually has decent paying jobs, that job growth slowed significantly. It's in today's report. If you'd like a copy, or if you're not a subscriber, we'll give you a sample. So we're starting to level off, and that's what I think that the markets were trying to do back in September, until the Fed held off on tightening and we had very weak jobs data. Then it was like, oh, the Fed's going to cure everything. Now today the markets were like, maybe the Fed is going to tighten, even if growth doesn't pick up from these levels. That's what I think happens. It might happen in December. I say it's about a 55% chance in December, 45% in March. But unless we see an economic slowdown, especially, as Ms. Yellen put, inflation reversal. So we see more disinflation. We see core PCE start to decline again. Not go negative, but progress at a more modest pace. Instead of 1.3, 1.4, maybe 1 or 1.1. then the Fed's probably going to come off the zero bound. You know, the markets keep pricing in not a Goldilocks scenario, I don't think, but a overly rosy scenario. And this overly rosy scenario is that the Fed is going to stay accommodative, and if it does it long enough, what will happen is that the economy will grow like it did before, just because. Nothing happened just because. Even when we revert to the mean as far as GDP growth goes, it happens for a reason. It happens for different reasons. Different policies are necessary to encourage growth in different eras, right? I think that's necessary, but we have gridlock in Washington, which might not be the worst thing in the world, because no decision is better than poor decisions. But I will have to say this, and I don't mean to get political, but there's no denying that the Affordable Health Care Act has encouraged more part-time job growth versus full-time job growth than might otherwise have occurred. And even the CEO of Paychex, Mr. Mucci, acknowledged that. And when Paychex released their jobs data yesterday. All right, this doesn't mean necessarily that an Affordable Care Act is bad for people, but it does have its consequences. And like any other decision, positives and negatives must be weighed. Nothing is ever unambiguously good or unambiguously bad, or few things are. I shouldn't say nothing. Few things are. All right. So maybe having more people covered is good. We'll see. But it does come with a consequence. And we're seeing that. So this brings me to another point on the jobs data. And I hear this mostly from the equity side, and it drives me a bit nuts. They'll point to 200,000 jobs, or today's ADP, 182,000 jobs. And look, that's decent job growth. We only need 100 to 125 to keep up with the population. Pay no attention that a decade or more ago, we needed 250 to 300 to keep up with the population growth. And before that, over 300. This is population growth slowing. But the problem is, when you have a part-time economy, you often get situations where you have one worker who's getting two jobs. It may be two part-time jobs, or full-time and a part-time, as they're trying to make ends meet with lower incomes. Remember, household incomes are the lowest in real terms, which as they were since 1996. So households are more constrained. And if you look at how households are spending, by this, so the consumer's fine. They're buying cars, they're buying iPhones, and they're going out to dinner and a movie. Okay, they're buying iPhones, cars, and going to dinner and a movie. They have X amount to spend, and that's where they're doing it. So they need a vehicle to get to their two jobs, so they buy a new one. They finance it for 8 years, or they lease it. Right? They get a little bit of a break from lower fuel prices. So what do? They go ahead and take the family out for dinner and a movie. Right? Their iPhone or their Samsung, their smartphone. This is no longer technology, guys. This is no longer a luxury. This is an appliance. As much as a refrigerator was to our parents or grandparents. You cannot look at these companies, these tech companies, as tech companies. They are the new industrials. Inelastic demand curve here, folks. Inelastic demand. So that's where the money's going. Okay? Is it bad? Not necessarily, but it's not like there's a plethora of disposable income in the economy. So when I look forward to this Friday's jobs data, I'm guessing now, it's an educated guess, about 175,000 jobs. And that's only because, we might see 180, 185, but that's because of the volatility this time of year in holiday hiring. Now, it used to be, decades ago, that most of the holiday hiring would happen in November and December. It happens now in October and November because the holiday shopping season, the holiday hiring season, the store stocking season starts a month early now. I was in Lowe's a couple weeks ago, and they already had their Christmas trees up and Christmas music playing. This was just after the middle of October. The holiday hiring, for the most part, has begun. And the problem is that the statistical models for payrolls still hasn't caught up, at least not as of the past few years, to the fact that a lot of the holiday hiring happens sooner. So what happens, and it has happened, is that we've seen a few times during this recovery, the October number surprisingly strong because the models did not figure in the holiday hiring, and when that hiring occurred, it pushed the seasonally adjusted number higher than it might have otherwise been. And then we've seen the December numbers kind of slack off because the seasonality formula still accounts for probably still accounts for more hiring in December than what happens, and then November is usually pretty solid, right? So I think what we're going to see here is that the seasonality formula doesn't account well for October holiday hiring, and that's why we get 175 to 185. Otherwise, we might have been 135, 145, 155. I think that's where we are as an economy. And that's going to keep slowing, I think, till we get around the replacement rate, which is, say, call it 120,000. I think that's what's going to happen. We've right-sized, and labor's been commoditized. There's talk about no productivity gains. Problem is that our equipment is so efficient that it's not cost effective in many cases to upgrade. There's still excess capacity within the equipment, and a lot of it just needs software upgrades or minor hardware upgrades to a bigger system. So you don't get that same type of productivity spike. So that's where we are on the Fed and jobs. The Fed probably slightly better than 50% chance that it goes in December, even without the economic data getting much better or any better, as long as it doesn't get worse, right? We're probably going to see a good October number, probably a good November payrolls number, but probably a resetting lower in December and or January. Right? Inflation probably doesn't pick up. Dollar's getting stronger. Unless we get too many dollars chasing too few goods or opportunities, we're probably not going to see inflation pick up. So we might see the headline inflation number start moving towards the core number as the year-over-year change in oil and gas dissipates, right? Because at some point we're going to get to a point where the year-over-year change is effectively zero or a little higher. But the core numbers, there's not a whole lot of upward pressure on that. So in other words, the economy you see is probably the economy you get. Now this is a problem for the equity guys and for the junk bond guys, because they keep building in a escape velocity scenario, and we're not getting there. And we saw that in the junk bond market last week, that they started to give up the ghost. It was realized, you know what, it's not getting that better. And the junk bond recovery just stalled. It stopped in its tracks. Started in triple C 2 weeks ago and went to double B and single B last week. Just pretty much stopped in its tracks. And the equity market now is getting bumpy. It's moving higher, but it's getting bumpy. And even some of the equity bulls are getting concerned that, hey, wait a minute, it's come too far too fast. And I think there's a lot of portfolio performance catching up by some institutional managers out there. And that's probably driving it higher. If the data doesn't support it, we could have a correction. And I heard one of the commentators today, Boris Schlossberg, I like Boris, he was on CNBC, and he said that he fears that the more this runs, the bigger the correction comes. And I think we see something in December, because the high yield bond market is telling you to expect something then. We hear stories about, the EPS has been good on stocks, the PE is not too high. All right, share buybacks disguise that. You want to get your earnings per share higher, right? Even though your revenues aren't rising and you can't cut much more, buy back your shares with cheap debt. You reduce the amount of the shares in your float, and now your earnings look better compared to the outstanding shares. I fixed my EPS. I cut my shares by 15%, and now my EPS looks 15% better without any appreciable gain in my earnings, especially revenue growth, which has been pretty poor. Retail sales have been bouncing around. So there's a lot of smoke and mirrors in the equity market. And by the way, this is why we've seen much of the recovery where among the large caps, among the mega caps. It's been the big stocks, the big companies that have led the way back. Now, the technical guys see a problem with this. They say, wow, this is a fragile recovery here, a fragile rebound, because small cap and some mid cap aren't participating. This is bad news. I think it's good news, at least for the economy. We've had such a misallocation or slash disallocation of capital the past 5 or 6 years. What this is kind of telling us, in my opinion, is that the capital now is going to be directed to where it can be used most efficiently. It's not going to be spread across the whole swath of the investment world. And some of the smaller companies, some of the less creditworthy companies, some of the underperformers from a fundamental standpoint are not going to get financed. I think this is a renormalization. I said this years ago writing in my reports. You'll see a renormalization of credit spreads, of correlations, of asset price performance when or just before the Fed renormalizes. Well, what are we seeing here? We're starting to see a separation of quality with more money flowing into the higher quality assets as what? As the Fed starts to renormalize. And no matter how bullish you are, you have to admit that when the Fed starts to renormalize, the best time for risk is over. Now, the problem is the Fed is renormalizing late in the cycle, and the Fed acknowledges this. The Fed officials have said this, that it's a late, especially those who are more hawkish. And the later in the cycle the Fed tightens, the less it has to tighten, and the quicker high risk assets correct. And we're seeing that. We're seeing that high yield bonds have not correlated with the broader equity market or with the major indices. But municipal bonds actually have. So figure that out. We're starting to see a renormalization. A renormalization means less risk taking, higher incidences of corporate defaults, and more peeking under the hood of investments. And that's where I think we're going. So I'm still buy quality on the dips, sell risk on the rips. I'd rather take a modicum of interest rate risk over reaching into credit risk. I don't see much of a reason for most, even aggressive accounts, but suitability matters most, but even aggressive accounts to dip below the double B area, except in various spots. Barbelling is my favorite strategy. Not that difficult to build a portfolio with an average rating of A, with an average duration of 6, with an average maturity of 7.5, and get 3% and be able to sleep at night. I still have the short end of the curve, assets on the short end to roll in case rates do rise, but have assets on the long end in case they don't. And I think investors and advisors are going to be very surprised how little rates move in compared to their expectations. Owning your maturity is going to be a big positive going forward, especially as demographics age, and that open-ended investment is just probably not going to do it. And the clock on the wall and on the screen says my time is up. So again, I think we see about 175,000 new jobs, probably still around 5.1 on the unemployment rate. Wage growth probably still 2.1, 2.2, and life goes on. And we'll see what happens, and I'll be back next week. Meanwhile, if you want a complimentary copy of my report, email me, thomas.byrne, B-Y-R-N-E, at WS, this Whiskey Sierra, the word and, the letter M as in Mike, .com, WSNM.com, thomas.byrne at WSNN.com, and I will send you a free copy of my report. If you want a free trial, email me the two. If you want to discuss things during market hours, except for tomorrow, I'll be at the Philly Fed at an energy conference, the Domestic Energy Independence Conference. But otherwise, you can reach me at my office during market hours, 570-424-1555. And with that, I'll say goodnight and tell your friends about Bond Squad. We try to be out in front. Have a great night.